with the conversation um, on tonight. I think all of us we'll note now that it's being recorded when we have our financial stewardship seminars. There are a few that we do not record because of the nature of the conversation, but we felt that this one is broad base and others can benefit. So we are recording, and as normal, we ask if you have any questions or comments, you can utilize the chat session, and those questions or comments will be shared and or utilize the Zoom reactions somewhere where it raises your hand or something like that. And you'll be unmuted so that you can raise your question and or concern. I'm grateful for this past year and the series that our stewardship and finance team has done. They've done an exceptional job this year in providing some real tangible workshops, training, education as it relates to our stewardship, because we are one who believes that it's not enough for me to just teach tithing if we do not help persons to manage and deal with the other 90 percent that God gives. And so we want everyone to be fruitful in every aspect of their life, not just their spiritual life, but just in life general, because it is our faith that informs our reality. So I'm grateful. I'm going to move out the way because we only have per se an hour. We're only going to keep you 1 hour. So move out the way so that Sister Chandel can come and introduce our presenter or presenters, and we can go from there. So, Sister Chandel, it's in your hands.
Thank you so much, Pastor. Thank you for your leadership and for your vision and entrusting the stewardship and finance team to bring this vision to reality. Um, my brothers and sisters, we have with us two persons who will discuss long-term care insurance, life insurance, and other topics that we feel as though would be of interest to us. I'm going to briefly introduce Sister Tamara Haskins, and we have Brother Joseph Joyner, and I'm going to let Sister Tamara introduce Brother Joyner. But Brother Joyner, for the people that are with us already know Sister Attorney Amy Griffin. This is her husband, and he also, we know, as Attorney Amy has said, he works in the insurance field. She has mentioned that a few times, so we're grateful to have him with us. And Sister Tamara Haskins and Brother Joyner, our colleagues. So we're grateful to have both of them, and I will let Sister Haskins introduce Brother Joyner. But I do have a brief bio on Sister Haskins, so I'll read this quickly. Tamara Haskins is a financial advisor with Eagle Strategies, with over 30 years of experience in accounting and financial services industry, and as a business owner. Tamara has been entrusted by her clients to help them build and preserve their wealth and plan towards their financial well-being. She is currently a financial services professional with New York Life Securities, LLC, a registered broker-dealer, and licensed insurance agent with New York Life Insurance Company in Bethesda, Maryland, specializing in retirement planning. She provides fee-based financial planning, investment advisory services, access to third-party investment management programs through Eagle Strategies, LLC. Eagle Strategies LLC is a registered investment advisor. Both Eagle Strategies and NY Life Securities are wholly owned subsidiaries of New York Life Insurance Company. Tamara graduated from Rutgers College School of Business, the State University of New Jersey, with a Bachelor's of Science degree in accounting. Yay for accountants. She obtained a master's in science and taxation for tax people too from Baruch College, the City University of New York. She has previously practiced as a CPA, such in prestigious CPA firms such as Ernst Young in New York City, Einzer Amper in New Jersey, and Dixon Hughes Goodman in Tyson's Corner. She has an extensive experience in closely held family-owned businesses and guiding high net worth individuals on tax savings and financial strategies. I told her name is Tamara. My sister's name is Tamara, so I always want to say Tamara when I see it. But Tamara worked at Merrill Lynch for 10 years as a certified financial manager and financial advisor. While working at Merrill Lynch, she appeared on WABC Channel 7 Money Talks, Good Morning America, Good Day New York, Fox 5 Channel 5, discussing tax saving strategies for high net worth clients. Tamara is happily married to Dwayne Haskins Sr. for over 25 years. They are the proud parents of two beautiful children. Tamia is a student at Savannah College of Art and Design, studying acting and film and television, and Dwayne Jr. is an OSU alumni and the starting quarterback for the Washington Redskins. So without any further ado, I will turn this over to Sister Tamara Haskins. Thank you so much for being with us.
Thank you so much. It's truly an honor and a pleasure to be before you. I also asked my colleague Joseph Joyner to join me, just to have another set of ears and to, we kind of piggyback off each other. And he's my tech guy. So whenever I screw up, he helps me with the tech stuff, and just to have another set of ears. So if I forget to say something, he'll remind me and say, hey, what about this? So Joseph's been in the industry with New York Life, and we work together on a lot of cases together. And like we mentioned, he's the proud husband of Amy, and I introduced them to. So it's a pleasure. So let me get in on the slides. Let's see here. Share my screen. Okay. So we already did those pleasantries, and here's Mr. Joyner. So we're going to be addressing some of the key financial planning topics. I know we said we're going to talk about life insurance and long-term care. We're going to touch on a few different things, but I always start with this slide because it's very telling. I look at it as, when we build a house, right? An architect doesn't build a house from the top up. He doesn't start building the roof and then work his way down. He starts at the bottom, right? Making sure that we have a strong foundation in place. So if we look at these 6 or 5 different items at the bottom, we always try to make sure that our clients have these things in place before we even start getting to building up the rooms. So first thing is making sure that you have a cash reserve. So anywhere between 3 to 6 months, just in case there's an emergency, things happen out of our control, and we don't want to have to resort to borrowing money or taking out loans at high interest rates. So having a reserve, so if we get laid off or if there's a death or things happen of that nature, we have some money set aside. The next thing is having health insurance. That's very key. We're in the middle of a pandemic. We didn't expect to be in this situation, but the cost of care, if you have to be in a hospital without having insurance, you can understand that could be a very costly item. Life insurance, we're going to get into a deeper dive on the life insurance front, but life insurance is a love gift. So if you care about someone and your desire is to protect your assets and to leave a legacy, life insurance is a great tax-free way to leave something to someone else. Then disability insurance, we're not going to focus too much on the disability side, but again, we can slip and fall, accidents happen, and what's going to happen if we can't do our job, right? If we can't earn a living, how can we maintain our lifestyle? So having disability insurance is also important. Normally, disability coverage will cover about 60% of your income, so it's not 100%, but at least have something in place should in case something happens to you. And then last but not least, long-term care insurance. We'll get into a deeper dive on that. But that's another one of those expenses that could bankrupt a person. It's one of the number one causes of bankruptcy because the cost for long-term care is very expensive and it's not covered through insurance. So as I mentioned, these foundation items, we always make sure that our clients are protected first with these things before we start moving up in building the other rooms of the house, but we'll touch a little bit on retirement planning, having 401ks and IRAs and stocks, bonds, and mutual funds to make sure that you're able to live your desired lifestyle in your retirement. So let's talk a little bit about the importance of life insurance, right? Today, more than ever before, there are tremendous financial burdens or pressures on families and individuals. The demands of keeping a roof overhead, educating our children, retirement planning, and the possibility of having to take care of aging parents is very taxing on our limited resources. So if you were to have passed away, would your loved ones will they be okay financially? And will they not create a financial burden on someone else? So we understand that we can't bring back a person after they pass away. But life insurance is a way to provide time and choices. So that's time to mourn the loss of a loved one, and the ability to have financial choices so you don't have to go back to work right away. So why suffer emotionally as well as financially? So when we look at life insurance, we look at it from an income replacement. That's one of the ways that you can look at it. Now, if you think about it, we have insurance on our homes in case there's a fire or a flood. We have insurance on our automobile in case we're in an accident. So why don't we have protection on our greatest asset if something were to happen to us, right? So we look at it as what we call the human life value. So if we lose income from lost wages on the death of a primary breadwinner, that will no longer be income that's coming into the household. So I use just a simple example of, what if a person earns about $50,000 a year? And what if they have small children? And most people want to provide for their children until they're old enough to be out on their own. So let's just say for the next 20 years, if there is a person, the breadwinner, has an untimely death, well, if you take their income of $50,000 times 20 years, that's $1 million of insurance. So we go through these numbers with our clients. They may want to replace income. They may want to replace assets. So being able to pay down a mortgage, or even just to be able to keep a roof over their head and to be able to provide for children to go to college.
Tamara, can I just piggyback on that real quick?
Yes,
Yeah.
thank you.
A lot of people don't even, I mean, that we come in contact with, they don't realize, how to, I guess, calculate how much insurance that they need. And when we take them through this practice or process, they understand it better, because they never think about, okay, they say, okay, I have insurance with my job. I have, 50,000, 100,000 with my job. But when you think about it, or when you pass away, is that going to be enough to take care of your family? If you're making $100,000 a year, that's only going to take care of your family for a year. If you're 35, you have the rest of your, another, 35 years easily to possibly work and bring in, an income. So being able to recognize what your value, your human life value is important. That's one of the things that we help our clients recognize as well.
Thank you for piggybacking, Joseph, and just expanding upon that, because it's really important. So let's talk a little bit about the wealth gap, right? So this is a study that New York Life has done in the community, and basically, if you look at the typical household of a non-African American person, i.e., a white person, they typically have 13 times the wealth of an African American person. Now, the most recent federal surveys put the difference in net worth between a typical white and Black family at $131,000. This is the widest gap since 1989, and the gap is just getting even bigger. So white families are 5 times as likely as Blacks to receive significant gifts and inheritance, and the sums that they tend to get are much higher, and the money can be used to jumpstart further wealth accumulation. For example, buying a home, starting a business, or even just building up equity. So we want to be more cognizant of that and see what we can do to change that narrative. We found that we are more spenders. We spend trillions of dollars as opposed to savers. And the average time that a dollar stays in our household is less than 6 hours, versus in other communities, it's, months before, that dollar is spent. Did you want to add anything to that, Joseph?
No, I think that tells a lot right there.
Yeah, it's a big deal. So life insurance is a wealth building tool, right? So life insurance is death protection and more. It's, as I mentioned before, protects our earnings. It can be used in retirement and to fund an education. It can be used as an additional stream of income, and it can create multi-generational wealth. However, for many African Americans, it's often misunderstood. There's perceptions and mistrust. We often think, oh, if we think about insurance, someone's going to pass away, or I don't want to make someone else wealthy or someone else rich, or we're not thinking about future generations. There is a 112-year lag in access and education, undervalued, and that we're not seeing our own economic value. So that's why we're bringing to individuals' attention, how to calculate your human wealth value. So other community issues. Home ownership rate for African American community is 43% versus 72% in the general market. African Americans are least likely to receive financial support during their lifetimes or inheritance from family members. African American entrepreneurs face more challenges to start and build businesses. Community organizations and institutions are funded by much smaller endowments as compared to the general markets. So they may have, we probably have billions versus their millions, versus their billions. So we want to do a better job at that.
And also, let me just to add in that, you got to think about with the African Americans, our community. You have to think, you add in there the systemic racism that is also part of, I guess, these statistics as well. So I just wanted to just mention that as well.
Yeah. So let's consider these questions, right? Can we close the racial wealth gap? Can we become wealth builders and not wealth spenders? Can we create legacies for family, businesses, churches, organizations, and institutions we love? Can we help eradicate poverty in the African American community? So these are some of the questions that we want to challenge ourselves with and see if we can do a better job for the future generations. So now we're going to talk about the two basic types of insurance, right? So when we think of insurance, we think of two basic types. There's various different types, but the two basic types are term and permanent insurance. And we look at it as renting versus owning, right? So if you think about term insurance, as I said, as renting, it's temporary coverage. Most term policies have an expiration date. You may have a policy that could be 5, 10, 15, 20 years. But at the end of that term, the costs will change and will go up. Similar to like rent, we rent a place, it may start out at one price, but the landlord can change the rent and it can go up. Term insurance generally only provides a death benefit. There's no cash value involved in term insurance, and there's generally no living benefits. So I'm not saying that there is a right or wrong type of insurance to have. A lot of our clients will have a combination of both. But the best type of insurance to have is the type that you can afford and will be there for you and in place for your beneficiaries upon your passing, i.e. you don't want the policy to lapse because you can't afford it, right? So let's look at permanent insurance or owning insurance. It's like owning a home, right? We might take out a fixed rate mortgage. The payments never increase versus a adjustable rate mortgage. A home builds equity, right? So we can pull the equity out of home, just like a permanent life insurance policy. You can pull equity out of the life insurance policy. So, i.e. it has cash value. However, if you take out the cash value, normally you do that in a form of a loan, and the loan is tax-free, but however, that loan would reduce the death benefit. You don't necessarily have to pay it back. It's not like a traditional loan where there's a scheduled time frame that you have to pay it back. But if you do take out a loan, it would reduce the death benefit. So say hypothetically, you took out a $50,000 policy and it grew cash value over time, and you had $10,000 in cash value. If you take out that cash value and do not pay that cash value back, then your $50,000 face value would be reduced to $40,000. So that's just a hypothetical example. So with permanent insurance, it provides living benefits. So if something happens to you while you're alive, you can use that cash for whatever purpose you want. It could be to replace income, for retirement purposes. It could be to pay down a mortgage. It could be to help a child with education funding. So think of it as an additional pool or additional asset that you can utilize in the future. Now, the great thing about, like I said, with permanent insurance, it is more expensive, but the cost never increases. So you don't have to worry about it like on a term policy where it may start out really, really inexpensive, but over time, that permanent policy will not increase in the cost. The premiums won't increase. However, the cash value as well as the death benefit will. And the reason and how it does increase is from companies that offer dividends. So New York Life is a mutual company. And with mutual companies, they actually provide their policyholders with dividends. So for the last 166 odd years, New York Life has paid dividends consecutively. Now, although dividends aren't guaranteed, it's based on the growth or the assets of the company, and they determine what the dividends are each and every year. So, Joseph, did you want to add anything? Did I forget any pointers on that?
Just one other thing, I guess, in reference to the temporary insurance or the term insurance. Most businesses will offer the employees group insurance, which is basically term insurance. Sometimes it will be at no cost to the employee, or sometimes they will, add a little cost to it. But one of the things about that is when you leave the company, either retire, just move on, or fire, whatever the case may be, you don't get to take that insurance with you. That's one of the reasons why we also recommend to our clients to always have, permanent insurance, or have some insurance on your own, as opposed to relying on what your employer provides for you.
Yeah, that's a great point. Thanks for bringing that up.
Mr. Mayor, can I ask a question?
Absolutely.
I guess that to me was good clarity, because I have insurance through my job, and they kind of base it on your salary, like you can get X number. And I kind of figured that if I were to leave the company, or something were to happen, but like even if you retire from the company, quote, what we call retirement these days, that policy is then, or does it go down in value, or does it go away?
That is a great question. So it really depends on the company. So some companies may or may not allow you to take it with you. If they do, it will not be at that relatively inexpensive rate that they offer to you on a group basis. So now it's going to be based on your age at the time when you retire. Let's use that as an example, and based on your health. So if your health has declined, then the cost of the insurance is definitely going to go up. So that's the big advantage of buying insurance the younger you are, because the younger you are, hopefully the more healthy you are, and insurance is based on your age and your insurability. So by buying, for an example, a permanent policy, you lock in your age and your insurability at that time. So I do recommend having coverage from your employer, because it's very inexpensive, but just keep in mind when you leave, most times the coverage won't go with you. Now, another thing, we work with a lot of government employees. So with government employees, one of the things they don't realize is that the cost of their term insurance goes up every 5 years. So we found at like age 45 and 50, we see that the cost tends to double. So if there's any individuals here that work for the federal government, we're more than happy to sit down with you and do an analysis to show you how the cost increases. And then when you retire, it's going to, again, be based on your age at that time and your insurability. Does that help? All right. So now, these are just other types of permanent insurance. We're not going to go in depth on these, but we just want you to know that there are different types. You may hear people talk about whole life insurance. Basically, whole life insurance is the type of insurance that you'll have for your whole life, hence the name. If you live till 80, till 90, till 100, as long as you pay the premiums, you'll have that insurance coverage for your whole life. Universal life is a permanent type of insurance. Universal life is one of those plans where it's more flexible. So you can actually determine the premiums. So if you need to reduce the premiums, you can actually have more flexibility in the cost of the payments. However, I do caution with universal life, it's based on interest rates. So if the plan is not properly funded, you could end up owing money later in life to keep that policy in force. So that's, universal life is just one of those plans where if you're concerned about, will I be able to keep up the premiums, you have some flexibility in the premiums. Variable life insurance is actually tied to investments. So I usually recommend this for a younger person that, they may say, well, a whole life policy is great, but I don't really see, the growth on that. I would like to get more growth than what a typical whole life policy would bring. Whole life would generally bring anywhere from a 4% to 6% rate of return versus a variable life is going to be based on the stock market. So if the stock market's doing double digits, then you would fully participate in the stock market. So that's just a quick overview of the different types. Now, I've often had people ask me about index universal life. New York Life does not participate in the index products. New York Life tends to be a more conservative company. Indexes are not regulated by FINRA, so they chose not to allow us to get involved in indexes. So does anybody have any questions on life insurance? Before we move on, I'm going to talk a little bit about taxes next. But if there's any clarity that you may need on the types of life insurance, Joseph and I are more than happy to address those.
Real quick question.
Sure, absolutely.
Now with COVID happening now, are they trying to change the terms, or if you've already had your policy, it would stay in place? I know they're trying to change things because they're paying out so much because of COVID deaths. So is that a new thing you have to look at now also?
No, not for policies that are already in place. The insurance company can't go back and say, oh, do you have COVID? Did you test positive for COVID? Oh, we want to increase the rates because we're paying out claims. Once you have a policy, whatever that price is that they quoted to you, they've already done the underwriting for it. They can't change it. However, for new individuals that are looking for policies, they are definitely scrutinizing it a lot more, closely. So I've had clients that have, submitted applications, and they may have in their records, like I had a client that's a doctor and they saw that she had a COVID test. They were like, well, what was the results of the COVID test? Now, a doctor has to get tested regularly. So I guess they didn't put two and two together, but they are definitely examining the medical records very closely. I wouldn't say that New York Life has increased their rates. I can't say that for other carriers. Joseph, I don't know, in your experience, have you come across anything like in terms of other than underwriting that I know that it's definitely more stricter, but maybe you might want to add something to that.
Yeah, I haven't seen them increase their rates, but as far as them being more stringent, yes, Tamara and I, we had clients that had planned to go overseas, go to, I think, Aruba or something like that. And they were declined because of the COVID and the travel restrictions. At first, it was certain countries that you could not go to. They would decline you because you're going to those countries. And then after a few months, they just opened it up as most of the world now. So I've seen that they've made a lot of changes that way. Also age as well, if you're with New York Life, if you're 60 and above, they are not going to give you what is called the temporary coverage. Temporary coverage is once you put your make the premium payment on it, you're covered. So if you're 60 and above, you're not going to they're not going to do that. So those are a couple of the changes that I've seen so far.
Yes. Yep.
So what is the I heard Sister is Tamara?
Yes, you can call me Tammy if that's easier. Okay. I go by Tammy as well, so that's easy, right? You can remember Tammy, so you can call me Tammy.
I know that she said, it's important to get it early, like when you're younger. But for the benefit, for the I don't want to say benefit, but for those who possibly did not get it when they were in their 20s or 30s, but now they are, in their early mid 40s. What is your recommendation there? Because what is your recommendation there that, okay, I didn't get it when I was younger, but now that I'm working and I'm in my career and I'm earning and things of that nature, as far as that particular age group?
Yeah, I mean, it's not too late. Definitely, it's not too late. I just mentioned that, one of the things that insurance companies look at, so they'll look at your health. So as you get older, your health, tends to change, right? So you want to try to get it as, as early as you can, but it's not that you cannot get it in your 40s and 50s. I mean, we have people that are applying in their 70s, but the cost of it is so expensive at that age. But what we do have is something called guaranteed issue for people that do have health issues or health concerns. For companies that have 50 plus employees, we can do something called guaranteed issue, where we don't ask them any medical questions, no exams, and they get coverage because they have 50 plus. Now, we also have something through AARP where we can provide coverage. We're the underwriters for the insurance for AARP members. So we have another thing called guaranteed issue for individuals age, it could be it's 45 and plus. So if you have pre-existing conditions, they won't, review your medical record. So that's not a fully underwritten product, but it is a little bit more costly because they're guaranteeing you coverage.
So is there a certain amount? Does the amount of the life insurance dictate whether or not they require you to take a physical exam?
So if you're going through a fully underwritten product, if you're getting, I would say $25,000, you may not go through a fully underwritten product where they actually come out and do your measurements, your height, your weight, your blood and urine. But I would say 100,000 and up, they would, examine your medical records and do a little bit more. I mean, you think about it, the risk that they're taking on, they're going to make sure that you're insurable if you're going through that route where you're going through a fully underwritten product. But on the guaranteed issue side, I mean, Joseph and I have done different schools, and I'm sure we could offer it to the congregation, to the church. So if you have more than 50 members, we would need a census, and then it could be any various ages in there where you can get coverage if there's some people there that are concerned. So we've had people that had cancer, diabetes, or what have you, that they probably couldn't get coverage. They couldn't qualify, but we were able to extend coverage.
And that's one of the things that Tamara and I stress when we meet with businesses that do have over 50 employees, because it's really, it's if there are pre-existing conditions where you're, type 2 diabetic, or if you have cancer, or if you have epileptic seizures, things like that, where you can't, if you go through a fully underwritten carrier, policy or carrier, you're not going to be able to get coverage. Or if they do decide to cover you, it's going to be extremely expensive. So we try to reach out to as many people as possible to let them know to take advantage of this, because there are no medical questions. There is no blood, urine, anything like that. And it's like say, hey, here it is. You have up to, can get up to 100,000, actually $200,000 worth of coverage. And that's something that you would not be able to get if you just go through regular normal underwriting if you have pre-existing conditions that are uninsurable.
Okay. And I was told that one of the measuring sticks for the amount of insurance that you should get is like the value of your home. So for example, if you purchased a home and that home is valued at 500,000, you should get life insurance for, 500,000 or over. Is that the same? Do you say that same advice, or has that changed?
No. It's one way to look at it. So you could look at it based on income or wealth replacement, like we talked about, your human life value. So income that would be lost. And you can also look at debt. So liabilities that you have outstanding. So I didn't go into the debt side, but again, paying off or paying down a mortgage, that's a good example. Being able to pay for a child's education, so college expenses. So we actually have calculators that we use, and we go through a very thorough analysis where we look at a client's assets as well as their liabilities. And, we'll say, if these are the things that you want to be able to maintain your standard of living, then yes, you should have X amount of coverage, to cover these things or to pay these things off. So that way we do a pretty thorough calculation. But what we want people to realize is that lost income is major. Because like you said, like I showed you with the simple, $50,000 income, if someone has a catastrophic death, they don't come home, they're in a car accident, that $50,000 a year, if they have young children and you're trying to provide for that, that's a big number that, is no longer coming into the household. So yes, to answer your question, we look at liabilities as well.
And also, let me just piggyback on that, and just to I guess further elaborate on your question, Pastor. That $500,000 house, yeah, that's one thing. But then, you like Tamara said, if you have young children and you want to plan for their college, and you kind of you calculate how much is are their college expenses going to be, that's another part that you're going to add to it. So I'll have this $500,000 that I'm going to put on my house, another $100,000 for my three children to go to, the college that I want them to go to, and then maybe any other thing that you have, any other debt that you have, or if you want to leave a legacy for your family. So you want to take care of the debt, so you don't leave your the people that you leave behind. You don't want to leave them in a place of I guess financially suffering as well. So they'll suffer emotionally, but don't leave them financially
Right.
messed up as well. So.
Because listen, the debt doesn't go away. So like if you have, for example, a car, a car payment, the dealership isn't going to say, oh, send me half of the payment because your spouse is no longer here. Just like the mortgage company, they're not going to say, send me half of the payment. So you have to think about your everyday expenses. You have, your gas and electric, so you have a bunch of expenses that are not going to go away when one spouse is no longer here. So and clothing, shoes, those things that you have to provide for your children. So you don't want to be a burden on another family member to be able to provide for your family.
And one last thing that I have to say, and we recognize that when we see, I guess, on the news or something like that, and it's a tragic accident or death, and they tell the story about the person, and then they say the family has set up a GoFundMe page to help with funeral expenses. That makes us sad, because we feel like we know that they didn't have the proper life insurance, or didn't have any life insurance, and now you have to rely on others to, I guess, help just at least just put you in the ground. Not even to mention, what your, I guess, the people that you leave behind, what position it puts them in.
So hopefully that helps. So
real quick though.
Yes. Sure.
I know I'm not going to hold you up with a bunch of questions.
No, you're fine.
But as you were saying, like if the church, which would have more than 50 members, offered life insurance, would that premium or whatever your monthly payment be cheaper? Because I'm 61 now. Would that be cheaper if the church offered it compared to me going out by myself to get my own policy with the same thing?
So that's a great
offering the same amount.
That's a great question. So with the guaranteed issue, it's going to be based at a standard rate. So if you are in super duper health, it would make sense for you to go through underwriting to see if you can get a better rating. The standard rating, although it's not, excessive, it's not like you're overpaying, but it is to get insurance across the board for everyone. Your rate is going to be at a higher rate than a person that's 20 years old. But to answer your question, it depends. So if you are in good health and you would want to go through a fully underwritten product, you can do it that way. Or if you don't want to go through, if you have pre-existing conditions and you want to get coverage, then that's where the guaranteed issue. I just mentioned that just to let you know that that's something that New York Life offers.
Okay, thank you.
You're welcome. So we're just going to shift gears a little bit and talk about taxes and where do we think tax rates are going, right? So tax rates are actually at historical lows, right? No one knows where tax rates are going to be in the future, right? So one of the things we try to help our clients with is to diversify their retirement assets because we don't know where tax rates are going to be. So this chart, I know it's a little small, but the orange shows like the highest tax rates, and this goes back to the 1930s, where you can see tax rates were actually were actually like in the 90s, 90%, and then the lowest tax rates, let me make this a little bit smaller. The lowest tax rates were actually in maybe like the 15, 20%. So if you look at, this is the past, and then this is now. So based on what we know now, given, we're in the middle of a pandemic, we have pumped so much money into the economy, all of these different packages that we've put into the economy, and we are probably trillions of dollars in debt. Where do you think tax rates are going? So we're going to do a quick polling question. Where do you think tax rates are going? Do you think they're going to increase, stay the same, or decrease? So just I guess we could do by way of hands. Do you think they're going to increase? Do you think they're going to stay the same? Or do you think they're going to decrease? So yeah, so that's basically what we're trying to educate our clients. And then this is a strategy that we use. We talk to our clients about, we call it our tax buckets, right? So how will taxes affect your portfolio? So gains or growth of your assets fall into 3 income taxation categories. So assets, as we talked about, puts monies in your pockets, right? Versus liabilities, they take monies out of your pocket. So when you look at these 3 tax buckets, so the purple bucket is things that are taxable now. You receive a 1099, you include the income on your tax returns, and you pay taxes on it today. Things that are tax deferred or in the middle, those are things that are taxed later. And I'll go through some examples of assets that are taxed later. And then the last bucket, or the green money bucket, is items that are never taxed. So they're tax-free. So if I don't tell you any more, where would you want most of your money to be taxed? Would you want it to be taxed now? Raise your hands. Now? Would you want it to be taxed later? Or would you want it to be taxed never? All right, I see some hands. All right, so let's go through some examples of the different tax buckets, right? So as I mentioned, the taxable now, that purple bucket, the first one, those are things like your savings accounts, CDs, your investment accounts, real estate, business income, even your earnings, they're taxed now. You receive a W-2, you pay ordinary income taxes on it now, right? Things that are taxed later, the middle bucket, or tax deferred, the yellow bucket, are your 401ks, IRAs, annuities, any type of tax deferred compensation plans. Those are all taxed later. And then last but not least, the last bucket are things that are taxed never. So Roth IRAs, Roth 401ks, those are, you put them in on an after-tax basis, and then you don't pay taxes on any of the growth when it comes out later. 529 plans, those are college savings plans that we set up for individuals, children's for their education. Those you put monies in on an after-tax basis, and when the money comes out, the growth, you don't pay any taxes on it. Municipal bonds is another example. And then the cash value of life insurance. We talked or touched on it a little bit, but this is the way that you can have monies that you don't receive a 1099, nothing to report to the IRS. So you take that money out, it is never taxed. So those are some examples. So I'll ask you this question. Are you happy where your assets are currently? And would you consider repositioning some of your assets just to help yourself, given that we don't know where tax rates are going in the future? So that's something that we can sit down and help you analyze it. This chart basically shows a tax diversification. This basically shows you how the different categories are shown. So let me make it a little bit. So we have the tax IRAs, 401ks, pension plans, KEO plans, profit sharing plans. Those are all monies that you put in on a pre-tax basis. You get a tax deduction up front. The monies grow tax deferred, but when you take it out, you have to pay taxes on it. The other thing you want to be cognizant of on retirement assets, if you need to pull them out before you reach 59 and a half, you will have to pay ordinary income taxes plus a 10% early withdrawal penalty. So I caution individuals, if they actually need to take monies out of these types of accounts, to be careful, because now you're going to have to pay more taxes than you need to. So again, our examples of our tax free are going to be our Roth IRAs, our tax-free municipal bonds, and our cash value of life insurance. We put them in on a tax-deferred basis, and then the monies come out tax-free. So here is a strategy that we use where if we just show a person, if you have $100,000 in retirement income, and all of that income was put in on a pre-tax basis, i.e. in your 401k, that $100,000 investment would be 100% taxable. So let's just assume that you're in the 22% tax bracket. That $100,000 times the 22% tax rate will cost you $22,000 in taxes. So net 100 minus the 22,000, you have $78,000 to spend after taxes. Well, this is a strategy that we use with our clients. We say, well, what if you were to divvy up the monies, right? Say hypothetically 50% is going into the 401k, or 50,000, and then the other 50,000 is going into a cash value life insurance plan. 100% again is going to be taxable on your 401k because you put that in on a pre-tax basis. So when it comes out in the future, you'll pay taxes. Now, this is going to be assuming that you're in a lower tax bracket. So $50,000 and that you're paying taxes on going to be at a 12% tax rate. So 12% on 50,000 is $6,000 in taxes, right? So we have that other 50,000. Remember, I said it's tax-free, so you don't pay anything. So the $50,000, when it comes out, there's zero taxes on it. So now you have 50,000 minus, or technically you have 100,000, the 50 from the 401k, the 50 on the cash value. So 100 minus the tax that you're going to pay on this piece, the 401k, 6,000. So net, you have now 94,000 to spend versus the $78,000 to spend. So does anybody have questions on that? I don't want to feel like I'm rushing through it, but I just want you to, get the feel for how we, try to help diversify our clients' portfolio. Any questions on that?
I guess just a quick point. So if you have, let's say you want to explore, and I know there are ways to do it, to explore this diversification, right? So you have money currently sitting in a 401k, but you want to shift it to a cash value life insurance policy. Is that possible?
I would say you wouldn't want to take it out of the 401k and pay taxes on it. Some people will do that and they'll convert it to a Roth or again, put it in cash value. I would say use future income that you're earning and place it on an after-tax basis so you don't have to worry about paying Uncle Sam. Let your 401k continue to grow tax deferred. I also say to individuals, I'm a registered rep, so I encourage you to contribute to your 401k, take advantage of company matches. So if your company matches, that's free money. Don't leave any money on the table. But I would say the strategy would be not to take out of your 401k to put it in there, but to do future contributions in there. Does that make sense?
Yes, yes, it does.
Okay. So then I'm just gonna, do just a quick summary of what I look at in terms of, it's never too late to start, right? You could start now. It's never too late, right? So again, 401k contributions or any type of systematic savings where you're contributing money, what you're going to do it automatically. Just like Pastor said, he talks to you about tithing. You give your 10% to God, to the church, and then you pay yourself back. So you contribute your 10% to your whatever savings vehicle that you can. And as I mentioned before, take advantage of company matches, because that's free money that you would be giving up if you didn't. Also, as your income increases, contribute more if you can to whatever type of plan that you're interested in. And then when you're thinking about retirement, think about what sources of income you're going to have in retirement. So in the past, people relied on pensions and Social Security to fund their retirement. Now things have changed. Social Security, if you go to ssa.gov, you can get what your estimated numbers are, but they keep changing when Social Security benefits you can get full benefits. So for example, now depending on your age, you can get benefits early at 62, but it's partial. But now they're up to age like 67 to get Social Security benefits. So they even say and they don't even send the statements anymore, but when you used to look at your statement, they say the Social Security fund you're not going to receive a dollar for dollar of what you put in. The fund may be exhausted by 2035. So what I'm saying to you is that the rules can be changed with Social Security. So know what sources of income you're going to have coming in. As you can see from this little chart, personal savings is going to be the big bulk of your retirement. So monies that you put away in IRAs, annuities, stocks, mutual funds, savings account, employer sponsored plans, 401ks and things of that nature, take advantage of those. But pension plans, as I mentioned before, only about 7% of companies even offer pension plans. So you want to definitely make sure that you're putting enough money aside to be able to live a comfortable retirement, because you may need anywhere between 70 and 80% of your income that you're earning now in retirement. And with longevity, people are living longer. You may need to have more money saved. So people used to maybe live into their 70s. Now people are living into their 80s and into their 90s. So your years of retirement are going to be longer. Hence, you're going to have more money set aside to be able to meet your desired retirement lifestyle. So let's take a quick polling question.
Can I just mention one thing too?
Absolutely.
Also, I guess as far as retirement is concerned, people in the federal government or, they have a retirement account. When they look at it and they say, wow, I have this big number, let's just say it's $500,000 and it looks like a whole lot of money, but you got to think about that. All that's gone in pre-tax. So when you take it out, that $500,000 that you think that you're going to live off, remember Uncle Sam is going to get his portion of it first. And then what's left is what you have to retire off of.
That's exactly right. So you got your federal and your state taxes. So sure. Yeah. So that example of Joseph saying 100,000, say you owe, 20% or 25% for federal plus the state. So another 5% or so. So 30% of that, or on that 150,000 is going in taxes, not all in one shot if you're not taking a lump sum, but ratably over the period of time, it's gonna you're going to be shared. That's going to be shared with the government. So quick polling question. I feel like my retirement savings total is behind where I should be at my age. Raise your hands. About where I should be at my age, or ahead of where I should be, and I have a cushion. So we can do a quick polling question to see where everybody is. So we can help you, with looking at your retirement assets, and making sure you're properly diversified, making sure you don't have all of your eggs in one basket, in case the market does take another nosedive. So this is a little survey that was taken for non-retirees. So this is the percentage of those that thought they perceived that their savings were on track. As you can see, all of them are under 50%. So no one thought 100% that they were on track. So this is the age from age 18 to 29. Only about 26% thought that they were on track. From age 30 to 44, 35% said they were on track. From age 45 to 59, 42% said they were on track. And 60 and above, only 45% were on track. So we have to figure out how we're going to get people to feel like they're, more on track. So how are we doing with time? Ooh, it's almost 8 o'clock. The long-term care, there's a lot to cover on long-term care. What I did was I provided Sister Shandell with a brochure that talks about long-term care. It goes over some of the features, the benefits, the costs. I'm more than happy to go through the long-term care piece if we have time. What do you think? Do you want to give them a little bit more time? It's up to you.
I'm thinking we're gonna have to table it until the next time, but we can definitely pass off that brochure. Pastor,
Sure.
am I right? Comes up.
Yeah, you're correct. We're gonna have to, we'll probably look at doing another,
Okay.
do another presentation specifically dealing with long-term care.
No problem. I know it's a lot of information. You guys asked a lot of great questions. So I'm glad I did give the brochure so that way you can read it over, ask any questions that you may have. You have our contact information. You're more than happy to, reach us. This is my cell phone number. That's Joseph's cell phone number. You have our email addresses on there as well as our website. So if you have specific questions, you can email or call us. We're more than happy to answer them. And again, thank you for the time. We really do appreciate it. And I can't believe how the time so quickly it went by.
Yes, thank you very much. We appreciate the opportunity to reach out to you all and speak with you. So thank you very much.
Thank you guys so much for being with us. And one thing I did want to make mention, Sister Tammy and Brother Joseph are definitely available and are willing. Sister Tammy had spoken to me before that they are willing to do free consultation appointments with people if you so desire. So you can just shoot me an email at stewardship@turner-ame.org, and I will pass that email on to Sister Tammy so she can be in direct contact with you. Again, that's stewardship@turner-ame.org if you would like to take advantage of the free consultation that she is offering to people joining us today. And thank you guys so much. This has definitely been helpful for me who had limited knowledge on life insurance. So I'm definitely grateful, and we'll pass along that brochure as well make sure this presentation gets posted. So
right. Awesome.
All right.
Happy holidays to everyone.
Thank you so much. Let me express appreciation again also to those persons whom have joined us on Facebook Live. Thank you so very much for joining us. And as Sister Shandell mentioned, if you're wanting more information from our guests this evening, please send us an email. And we'll be happy to pass that information along. We have to have you to come back. And so I appreciate all that you've done. Thank you so much, Sister Shandell, for your leadership. And I don't believe we opened with the word of prayer, but we need to close out with the word of prayer. All right, let's pray. Eternal God, we thank you for this time that we have shared together. We thank you for what was shared. We thank you for every question, every comment. We thank you, God, for every person. We pray now that you would envelop us with your love, with your peace, your power, and your protection. We thank you for the victory that you have given to us. Continue to cover us with your blood. Bless every person that's under the sound of my voice. And as we depart from this place, but never from your presence, God, lead and guide us. And when we lay our heads upon our pillow tonight, give us a sweet sleep so that in the morning when we arise, we will declare this is the day that you have made. In the strong and powerful name of the one who gave his life, we do pray. Amen.
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 All right. God bless you all. Have a good night. God bless.
Take care. God bless.